Hello and welcome to CMC Markets Weekly Trading Outlook for the week of November the 17th, 2014. My name is Colin Szynski, Chief Market Strategist. Our topic this week is the U.S. rally done or is it just getting started? There's a number, as we reach the end of the week, we're seeing a number of conflicting indicators out there making us wonder if the U.S. markets are getting due for a correction or if having achieved new highs, they're ready to continue to move higher from here. Just looking back, we've had over the last month, we've had a pretty substantial rally in U.S. indices up off of their lows of October the 15th. As in the last couple of days, we've seen the Dow and the S&P hit new all-time highs, but there hasn't really been much enthusiasm beyond that. We're seeing that they've spiked up intraday, but then kind of finished the day flat, slightly higher, slightly lower. They don't seem to want to really take off from here. And on Friday, the 14th, we're seeing something interesting where we've had good news out of the U.S. We had better than expected retail sales, better than expected consumer confidence, and the Dow and the Nasdaq are actually down as of the point where I'm recording here. And this is suggesting that perhaps the U.S. markets are starting to look a little bit exhausted. This rally's been almost straight up for a month. It's looking long in the tooth, and it looks like we're getting ready for perhaps a pause, perhaps a correction. It's a little bit early to say. And we're seeing this indecision in our client sentiment readings, and I'll start here by showing the S&P 500. For example, if we look at the number of clients, we actually have clients are 58% long on top clients on the S&P. However, when we look at the value of the positions, all clients are 89% short and top clients are 68% short. So what does this tell me? It tells me that there's a certain number of clients that are still bullish on the S&P, but the bears seem to have more conviction at this point because they're going short in size. We have it looks as though larger positions on the short side, smaller positions on the long side, which suggests a shift between in confidence where perhaps the bulls are starting to lose some of their conviction, trimming back on their positions, whereas the bears are starting to bulk up. We'll look at the chart here for the S&P 500 as an example to show what's been going on here. We've had a pretty solid rally here. It's a big spike, but what's interesting about this, we've seen it going from mid-August up, and now it's starting to level off over the last few days. There's a doji there. There's a hanging man there. This has so far been looking as though, and generally the range between the highs and lows have been getting fairly smaller and smaller, which just suggests we're kind of going from clearly the bears being in control to clearly the bulls being in control to things coming back into balance here. And so the question we ask ourselves now is, do we continue going sideways? Do we use this as a pause? Is this a pause and a launch pad for another move higher? Or are we starting to roll down and perhaps seeing a correction like we had in July or even the one we had into September? The other thing to note here is we are seeing the RSI getting overbought again, so this rally's getting pretty overextended. It has not rolled back under 70 yet, so we have not had the correction signal we're overbought, but it could stay overbought. Similarly to here where it got overbought and stayed overbought a little while. This was back in August and early September. Looking at seasonal factors, we are well into November and December, which have historically been positive months of the year for stocks. However, we have to ask ourselves if the good news of Friday was not enough to propel U.S. indices higher. What's it going to take? Because the much of this rebound was driven by positive earnings reports, but earnings season is now over. So we're done with looking back at Q3 results, and we got to start thinking about Q4 results and what does this mean going forward. The other thing we have to look at is the divergence between the U.S. market and other things. I mean, it's been going great guns here in U.S. indices. Everybody's been really having, okay, great, the U.S. economy is going to continue to rally. However, it would be doing this in the face of a weakening global economy, and I'll pull up the Germany 30 to show what I mean. While the U.S. indices have continued to climb, it hasn't been the case in Europe at all. We've actually starting to see a negative divergence again. And at first, the rally was pretty broad-based, with coming up from mid-October. Not only did U.S. indices climb, but so did a number of other depressed markets. We see this huge rally, spike rally here in the DAX. However, as we look here into the last week or so, it's starting to come back down. We're seeing lower highs, a sign of distribution. We are getting these long shadows down towards about 9180, 9200 on the DAX, but overall it looks as though it's leveled off and is starting to weaken. And what are we seeing down here on the RSI? We've got a lower high, which is confirming the lower high on the index, and the momentum here is starting to roll over as well. So as the U.S. indices have been climbing into new high territory, the air's been getting pretty thin, the breadth has been shrinking, and so this leads us to wonder if will they continue to move higher from here, or are they getting due for a correction along with other markets around the world? The next interesting thing I wanted to take a look at is action in commodity prices. It's been particularly the crude oil markets, which over the last week have been extremely volatile and we may remain choppy into the coming week. If we look at crude oil West Texas, here is a fascinating example where we have it's been under heavy selling pressure. A lot of clients appear to be shifting though and trying to pick the bottom basically, and we're seeing the number of clients going up in terms of being long. However, on the looking and following the dollar, the clients are still net short here. All clients are only marginally short at 8%, but top clients, the ones who have been profitable for the last 3 months, are still 51% short in terms of position value. We've had a fairly substantial rally on Friday in both Brent and in WTI, and this jump of 21% in one day, it suggests to me that what's happening is that our top clients have been basically shorting into this bounce in size. I think that people are looking at this perhaps as a dead cat bounce. We've seen that crude oil on WTI had broken 77, on Brent had broken 80. They sold off. They're rebounding on what might be some short covering ahead of the weekend, but clearly there is still resistance. They haven't gotten back to their breakdown points, and we are seeing some clients appear to be taking advantage of that and seeing this as an opportunity to sell into the rally. And if we look at the charts, I'll bring up both Brent and WTI. I'll start with Texas. And so what are we seeing here? This is a long-term monthly chart. We're seeing we're in a pretty heavy downtrend here. We are starting to get a little oversold. We could get more oversold. I'm going to bring this back to a daily chart. And we'll see what we've got. We're under fairly consistent pressure here. We broke down below 77, had a big day down, and we've had a bit of a reversal here, but it's kind of too early to really call this much of a real day. It's not a key reversal. It's more of a trading bounce here. We're having an inside day, which is not unusual. We are oversold on the RSI, so it's not a surprise we're getting a bit of a bounce. But really, if we don't get back above 77.50 in here, then this is still just a normal consolidation within a larger downtrend with further support. We're seeing it's right now around 75. This low is around 73.50, and next support around 71.25. If we take a look at Brent crude here, we will see this is again a long-term monthly chart where for quite a long time it's been trading fairly sideways after a big rally from 2009 to 2010, another spike up into 2011 with the Arab Spring. Since then, it's been going sideways in the huge channel between about 100 and 120, and then in the last couple of months, the bottom's fallen right out from under it. And really, the next support, a big long-term support, is in here in this 69.50 to 70 area. It's still in and around 78. It's broken 80 and has not retaken that. So if we go back now to the daily chart for Brent crude here, we can see it taking out 80. Not only did it take out 80, but that was kind of near it slipped under. That then became the retest as new resistance, and then kaboom, it just went down. It's like a whole bunch of stops were taken out and margin calls. And today on Friday here again, we're having an inside day. RSI is oversold, so we're getting a bit of a pause here. But as we can see, it got deeply oversold in early October. Really didn't come back very far. It's gotten oversold again. Now the one thing you could see is this is a bit of a higher low in the RSI, so you are getting a positive divergence coming in here, which I'll show with the drawing tool. Just bear with me for 1 second. So we are here getting a positive divergence coming in. So that is a sign that downward momentum may be starting to slow, but it's probably too early to call a turn on this one. We're at a point where, yeah, the downside is probably relatively limited, but it doesn't mean we're necessarily ready to go first. After the technical damage that's been done of the last few months, this may take a while of base building. You could see some double bottoms and false starts and things like that along the way. So it's too early to call a bottom for Brent, although some people seem to be trying to pick one, and some people have been trying to sell into this rebound here. So still very indecisive towards Brent and WTI. What this does suggest is we're likely to see them remain choppy right through the next week. Similarly, we've seen some a lot of choppiness in gold. Gold has been all over the place. Currently, we're finding here that we have 36% of all clients are short gold, 75% of top clients are short gold. So that's a pretty big discrepancy here between the two. If we look at the chart of gold, it's been all over the place, particularly in the last couple of days. As I bring it up here, we'll see it's been bouncing around. It's had a sell-off here in late October, early November. Currently, it's bouncing around between about 1130 and about 1180, with some initial support here around 1142 is a Fibonacci level. Gold got oversold. We are seeing the downward pressure easing, but we have not gone above 50 on the RSI yet. We're still base building. On Friday, we've seen nearly both ends of this trading range. We saw gold get pounded early on down to just under 1150. It's then turned right around and rallied back up towards the higher end of the channel, up above 1170, and it's even touched 1180 at one point today. So a very volatile intraday trading for gold. Lots of opportunities for short-term trading in gold. It is range bound. If it breaks out of this, next resistance is about 1200, and again the low here is in this 1130 to 1140 area. We could see quite a bit of choppiness in gold over the next week or so. Now, what's been happening with gold that's caused this is that there's been quite a bit of intraday action in the U.S. dollar. I'm just going to bring up the U.S. dollar index here briefly to show it, and because what's interesting here was that we had seen gold spike up on the retail sales news, and then on the consumer confidence news it came back down. So what have we had? Had a big advance in U.S. dollar. It's been leveling off. It's tried to go in both directions today. The trend is still favorable. There's still a trend of these higher lows here, which I will bring up. So we still have this nice little trend here of higher lows and below resistance. So it's basically still an ascending triangle forming, still a consolidation pattern here, but we could see some choppiness along the way in U.S. dollars. Offsetting this, by the way, is a small little negative divergences here and here in the RSI, telling us that there is some potentially that some of the upward momentum in the U.S. dollar has been slowing. We could see action in significant action in currency markets next week. There is not a lot of economic news. The one major economic indicator coming out is flash purchasing managers for China, Japan, Germany, France, and the United States. And so for China and for Europe, people are going to be looking to say, well, how are things going in November? Are things still slowing down, or are they stabilizing? For the U.S., it's the flip side. Is the U.S. recovery train bandwagon still going, or is it slowing at all? And what does that mean for employment and interest rates? So, but really, what the main thing we'll see people likely key on over the next week is meeting minutes. We have meeting minutes coming out for Australia, for the UK, as well as for the United States, and we'll think about the implications of this. First of all, for the U.S., the Fed had gone to be more hawkish in the statement last time. It was perceived of doing that perhaps it would start to now the tapering is done, now the QE3 is done, that they're going to start thinking more actively about going to raising interest rates sometime next year. This general speculation is around the middle of 2015. Anything that could accelerate that could be seen as bullish for the U.S. dollar and potentially bearish for stocks as we see the liquidity effect from QE start to go away. the looking at the minutes, the statement had shown that the two hawkish dissenters had dropped their dissent, and there was one dovish dissenter. So the Fed does seem to be shifting a little bit more toward hawkishness. If this continues to play out through the minutes, you could see more support come in behind the U.S. dollar, which could pressure other currencies, including gold and others. And I'll also start with so we'll start by looking at gold versus the U.S. dollar versus the euro here. Euro dollar we will bring up first. And what we're seeing here with euro dollar, pretty established downtrend, still lower lows, still lower highs. The RSI is leveled off in here, but it's still under 50. Downward momentum still intact. Currently trading between about 123.60 and about 125. This 125, after being broken, has been confirmed as on multiple times as a new resistance level. So even when the euro tries to bounce back, it's really not getting very far. If it takes out this 123.70, then we could see it a fall back. That would be a measured 130, take you back probably around 122.50 or so on the potential next down leg. And if we can see, here still lower lows in the highs in the RSI. It's drifting down, downward pressure increasing. So why are we seeing this? Because we're still really waiting for the Euro ECB to get going with their stimulus in October. Their balance sheet actually shrank a little bit, whereas the U.S. Fed's balance sheet continued to increase. Yet, if you listen to them talk, the Fed's talking more hawkish, and the ECB's talking about bond buying. So at some point, this bond buying program may actually get going more seriously, and when it does, it could still keep pressure on the euro. The another currency that's been under substantially even more pressure is sterling, and that could have a particularly active week in the next week or so. We're seeing it's been quite a downtrend for the last little while. I'm just going to shift it over here to a daily chart. And so what have we got here? In the latter 3 days of last week, we've seen it fail at $1.60. Resistance moved down to 159.50, and now it keeps on falling. It took out 158, and the bottom has fallen out, and it's just kept right on going. What happened? The UK had been widely considered to be the other central bank most likely to raise interest rates other than the Fed. So they were seen as being more in the hawkish camp, with the UK improving. But with the European economy going off the rails, the Bank of England has backed off and said, well, we could get impacted by this. They've lowered their inflation forecast. You lower the inflation forecast, takes the pressure off the central bank to raise interest rates, and what are we seeing? We've got the pound under pressure now. So it's fallen from 159 down to a low near 156 in about 3 days, and even though it is starting to get a tiny bit oversold on the RSI, we can see from back here in the summer that it can get a lot more oversold, and so this potentially still looks vulnerable here to further pressures. Now, the UK meeting minutes from the last MPC meeting also come out on Wednesday, same day as the Fed. What people will be watching for there is, has any change happened in the voting? Last time it was 7-2 with two hawkish dissenters. What people will be looking for is, was there anything to convince MPC members in the minutes ahead of them actually making the change in their inflation forecasts, and what does that mean for the pound going forward? People thought at one point, well, maybe the Bank of England might move ahead of the Fed. It now looks like they would probably move after the Fed. They were using for their own assumptions a first rate hike in the third quarter between July and September. So that's putting them likely either about the same time or even after the Fed. And who knows if that gets pushed off farther if the UK economy starts to spin its wheels again. A couple of other things I wanted to highlight here. I'll look at Aussie dollar as well as Canadian dollar. In terms of the Australian dollar, and the Kiwi dollar chart, by the way, looks quite similar. We have the Aussie dollar here has been trying to base build between a low near 85.50 and a high near about 87.70. It's trading back and forth in the channel here. RSI remains stuck below 50, so it's still in a downtrend. We do have RBA meeting minutes coming out early in the week, which could spark some activity in this, but it's hard to say. There's likely not going to be much change in the minutes, but we could see a bit of trading around that. It looks as though for this one it seems pretty range bound. Kiwi dollar also fairly range bound in between 77 and 80 cents, and every time this gets close to 80 cents, it still gets knocked back a little bit. There's still some fear of the the RBNZ getting involved and intervening in currency markets. Speaking of central bank interventions, another one to keep an eye on this week is the Euro Swiss. Here we go, Euro Swiss. For the last quite a while now, the Swiss National Bank has had a. We'll just show it here, actually on the weekly chart. For pretty much the last 3 years, the Swiss National Bank has had a range for Euro Swiss of about $1.20 floor to about $1.25 high. They haven't been so much worried about defending the high, but they've been pretty serious about defending this $1.20 low, and it's now gotten back to this again. In fact, it spent the latter part of the last week just trading within a few pips of this fairly significant low here. So the question is going to be at this point, will the SNB continue to defend $1.20 or not? Well, that should play out, be an interesting thing playing out over the next week or so. Final currency I wanted to take a look at here is the Canadian dollar. The Canadian dollar has been impacted a lot by swings in the crude oil price. Well, remember in this one, when here the U.S. is the base pair, so this is the U.S. dollar going up and down. So an increase in dollar CAD is a decrease in the Canadian dollar, and we've seen as crude oil has been tracking lower, U.S. dollar CAD has been going higher. And what have we seen lately? We are getting a little bit of a correction here. We've had some positive economic news out of Canada. Earlier this month it was employment, more recently manufacturing sales. Some of the more recent Canadian data has been improving. It does suggest that the U.S. recovery has been started to spill over into Canada, and but will this continue to impact it, or will crude oil remain the primary driver for loonie trading? Remains to be seen. But the recent highs for the loonie, this is 114.70. These here are about 114.25, 114 even. Initial support at about 113, and then the 50-day moving average is here about 111.90. So even though we are starting to see that RSI has come back off, upward momentum slowing a little bit, the broader positive momentum remains intact as long as the RSI holds above 50. So this so far is looking like another consolidation within an uptrend, but if we did start to see it break 113, or particularly this 111.90, that would be more indicative of a rollover for the loonie. But it's too early to call that yet. So basically, as we move into the new week, we're at a point where we've had some pretty strong moves across a number of markets. Some pretty strong moves upward for some markets. Some pretty strong moves downward for some markets. The question now is, do we pause here? Do these moves continue, or do we start to see reversals? And that's something we're likely to be the big theme in trading over the next week or so.